Hi, Harry here on August 25th for the Rant. And you know, this bounce from the first crash. I mean, again, remember, we finally had a big enough first crash in early 2022 to say, the bubble's probably over, okay? And this bounce, you would expect to be 4, 5, 6 months from past bounces off of a crash that steep. Well, it's gone 7 months, for the NASDAQ and 9 months for the S&P 500. So this bounce has gone higher and longer than would be typical, and that what happened in the 29 crash, okay? So that's what we're dealing with here, folks. But of course, we would expect this to be abnormal because we've been mucked up with so much stimulus for 14 years now that the markets don't know what side's up or down anymore. So I do think that the markets, it does look to me now like on July 18th, the NASDAQ, which is the one I'm tracking because the NASDAQ is the most bubbly of the major indices, peaked on July 18th, okay? And it's starting to head down, and we've seen a wave down, and now we're bouncing against that, okay? So this should turn down soon if we are really heading into the third wave down. The third wave down, I've been saying, is important. It's the middle wave. It's usually the strongest wave, but in this case, it will confirm if we do go to new lows below the 10,088 in the first wave down in the NASDAQ, it will show that we are in this major crash I'm talking about. And despite all the assumptions of the market, well, the Fed will come back after tightening and they'll be there. No, the market's breaking down anyway. And the more the market breaks down, the more people lose confidence both in the markets and in the Fed's ability to control them. So again, this is what we need to prove that this market crash is getting more serious. Now, if we are starting this third wave, which I'm very hopeful, then the obvious target here, there really is no clear support unless we go all the way to the COVID lows in late March 2020, okay? Now, why is that important? For the third wave to go down there, it would first have to be a slightly bigger crash than the first wave, and it would take the NASDAQ down 58%, maybe 60, okay? So that's when, again, we know we're in a serious crash. That's when people are gonna say, oh my gosh, yes, the Fed's lost control, and yes, we don't get something for nothing, which is my big thing. So again, that's what we're looking for, and that should take into the end of this year or early next year. So this wave 3 is probably most likely to go down to maybe January or so, December at least, and maybe February out there. And then that would be followed by more. Now, the most questions I get, obviously, TLT, the Treasury bond play. That is the ultimate safe haven. And you have to remember, unlike stocks, if you're shorting stocks, they will go down and up with the short all the way down. But the TLT is a much less volatile play, the Treasury bonds, but they make most of their gains right in the heart of the crisis. It was the second half of 2008. They made most of their gains, and they went up 50% last time, and I'm projecting they could go up as much as 100%. In other words, my target for TLT, look at the chart, okay, is still 186, maybe higher, okay? We're at 95 recently, and it's been as low as 92, okay? That's a doubling, which could happen in the next year and a half, 2 years max. This will be the greatest run in Treasury bonds ever. The greatest move up or down. In this case, it'll be up in value. And not just past, I'm saying it'll be the greatest boom we ever see for decades ahead. So this is important, and this is why this is so hard to catch. I think the smart money knows this, and they are trying to shake everybody out first. So we just have to hold in there. I gave a buy signal at 97. The bottom was at 92. I think I might have given a buy signal earlier at 93. We just got to hold those positions at this point. And the market keeps getting down a little bit, but we could even retest that 92 low or a little lower, but I still don't even think that's going to happen. This is a big play. You don't want to miss it. Better to be safe than sorry and be in. And again, we should see this really show itself when the market really gets ugly, and then it'll be, very clear probably about 6 months or 8 months in when to sell this. And also just to remind you, the magnitude of this crash. Now, we are in a unique situation, okay? This should be like the 29 to 32 crash, 80% plus, wipe out the bubble entirely, real estate and stocks in this case, so we can move on. But we also know, unlike in the Roaring 20s bubble, which was not largely fed by the Fed and central bank stimulation, it was fed by a really hot boom, just like the 90s tech boom. It's very similar. So this one is artificial, so it should burst even more, but governments are going to likely turn around and try to fight this as soon as they realize they've tightened too soon. And you know, this is going to happen coming up. And it's hard to tell because it's going to look embarrassing for them to tighten this strong and suddenly go back, suddenly, without even pausing, to go back to being accommodative and loosening and lowering rates again. So this is going to be a tricky scenario. But I still say we are in this window in the next 6 to 12 months where the Fed's still more in a tightening mode or holding that, and the economy starts to weaken on a lag. And remember, I've showed recent updates and stuff that the big surge in the money supply from the, you know, all the stimulus, basically 5.2 trillion hit in 2 years, peaking early last year. Now, on a 12 to 18 month lag, that stimulus is still hitting about the peak, and it's going to drop off. And now this tightening that started early last year on a lag is going to get more and more powerful into the next year. So everything in the next year and a half says markets are going to go down, and I think we're going to have the hard landing. So we will see, but this is the time to be out and be cautious, and I'll keep you updated.